Okay, so if you are a foreigner and you're wanting to do business in the US, then you need to make sure you know about these 5 things. Hey everyone, my name is Cameron. I am the founder of BizBud, and we are a team of tax advisors and CPAs that help digital nomads and small business owners in the US save a bunch of money in taxes, as well as foreigners. We help a lot of foreigners set up businesses in the US and take advantage of a lot of beneficial and fun tax breaks and things that are only applicable for non-US citizens. So you guys have basically the fun, and I'm quite jealous actually of your situation, because you get to take advantage of a lot of tax rules that US citizens cannot. And if you're thinking about investing in the US, if you're thinking about starting a business there and wondering how it all works or set up, then please just contact us, set up a free discovery call, and we're happy to listen to your situation and see what makes sense, because every situation is different, and a lot of times it goes outside the scope of these videos, even though these videos can be helpful. Without further ado, let's get into it. So the first thing you should know as someone who wants to do business in the US as a foreigner or non-US resident or tax person is effectively connected income, or ECI. And what is ECI? We've talked about it in other videos, but basically it is if you have any US sourced income or not. Basically, if you have US sourced income, then you would have to pay US tax, fill out a 1040-NR, or if you have an entity, fill out a business return. But basically, essentially it is, if you can connect or your income was sourced in the US, then you have to, might have some tax obligations in the US. So why you need to know this is because if you are a service provider, let's say you are a marketing agency or something, and no one in your company lives in the US, then you can set up, a lot of times we help clients set up a business in the US, an LLC, and then they provide the service for that business of the US LLC outside the US, so they have no ECI, or effectively connected income. So how commonly we could see this work is, like, let's say you're in Argentina and you're from Argentina, and you have a marketing agency and you want to sell to the US, you want to invoice from the US, or you want to provide your services to Argentinians or other countries. So you basically can set up a US LLC, and we can help you set it all up, and you have a US bank account for that business. And basically you could now start marketing yourself as that and start providing marketing services either to US businesses, to Argentinian businesses, wherever, and you can have all this income come into that business, and you wouldn't pay any US tax because you don't have ECI. Now you have to make sure you don't trigger ECI, and what things commonly you see that trigger it. If, let's say, you have a store or you're coming to the US, and let's say if you're a marketing agency, you're meeting with business owners in the US, and you're physically in the US, that would trigger it. So you don't want to do that. Try to keep it all on Zoom, online, or sometimes if you're e-commerce, then sometimes if you store enough, if you buy a warehouse, obviously that would trigger it. If you have real estate, that triggers it. But sometimes even if you store enough inventory at certain distribution centers in some states, they might trigger it, but you need to look at it, at your situation further in depth. But it is something to be aware of. Usually it's not the case, but sometimes it could be. So yeah, you should know what ECI is and be aware of it, take advantage of it if you can. The second thing is, if you want to really win the tax game as a foreigner, the US, is called the 183 days substantial presence test. Now what this test is, there's 2 parts. You need to be in the US for 31 days for the current calendar year, and then 183 days for the past 3 years. And basically how the calculation goes, let's say this year you are in the US for 100 days, and then the prior year you were in the US for 100 days, and then the year before that you were in the US for 100 days. So they would count, how it counts for your test is, it's 100% of the days for this year. So that's this year. The previous year, it's 1/3 of the days, and the year before that is a 1/6. So in this example, 100 days for this year, okay, you got them all. Years before that, 1/3, so let's say 33 days. So now you're at 33 plus 133 days. Year before that, you did 100 days, but you only count a 1/6 of that. So a 1/6 out of 100 is around 17 days. So 17 plus 33 plus 100, that's 150 days. So 150 days is less than 183 days. So you didn't trigger substantial presence, so you wouldn't owe any tax. So that's basically how you have to look at it from that. So you want to make sure, if you're trying not to pay or trigger US tax obligations as a foreigner, that you stay outside of the US in 183 days or less, and 31 days in this current year, 183 days or less in the this year and the prior 3 years combined based on those rules, and you won't trigger it. Basically, an easy way to know how to do it is if you're in the US 120 days or less for 3 years, you're not going to trigger it. You're not going to trigger substantial precedent. So if you are, which is basically 4 months. So if you're in the US longer than 4 months in back-to-back years, you might want to start making sure you don't go in the US for another year to trigger this. There are some exceptions to this, depending on the visa you have. Like a lot of student visas, you would be exempt from this, as well as teaching visas, like the Q visas, stuff like that. So look at your visa type and make sure it gets you exempt from that. But regardless, that's something you should be aware of. The third thing you should be aware of as a foreigner in the US is known as FDAP, or Fixed Determiner Annual Periodical Income. A lot of times this is just like passive income. So interest, royalties, rents, stuff like this. This type of income is subject to FDAP tax, which is 30% withholding on your income. So let's say you have some investments and pays you dividends. That dividend income is going to be withheld, taxed 30% withholding. Now, if your country has a tax treaty, like if you're in the UK, sometimes you can get that withholding reduced. So in the UK, there currently is like a 15% withholding treaty. So basically instead of 30%, it's only 15%. And if you do feel like the FDAP 30% was withheld higher than it should have been, then you can file a 1040-NR return and get a refund for the amount that was withheld. But this is just something you should be aware of. So if you have any passive investments in the US, they're gonna withhold 30% unless you plan accordingly and try to make sure that either you have tax treaties or there's ways around it. And sometimes it's better to just trigger ECI, or effectively connected incomes. If you do that, like with rental property, you can not be subject to the FDAP, and then you would just pay tax as you would file a 1040-NR non-resident return, and then you would just pay the tax owed. And a lot of times that's less. You would only want to trigger it if it's less than the 30%. So for example, with rental income, you can, if you trigger ECI, you're like, yeah, obviously I have a rental property, and I'm actively managing it. So therefore, I trigger it, and then you can take your expenses like utilities, interest, or insurance, depreciation, all those things to drop your rental income taxable gain. So 9 times out of 10, you should trigger ECI for if you have own rental real estate. And the next thing is FIRPTA. And FIRPTA, it sounds like, that crazy ex-girlfriend that your cousin told you not to talk to and then anyway ended up ruining your life. But it stands for Foreign Investment in Real Property Tax Act. But essentially what FIRPTA is it's 15% on the sale price of real property in the US. So a lot of times this applies to real estate. So if you own an investment property in the US as a foreigner, then they're going to subject you to FIRPTA, this 15% of holding. And it's on the sale price. So I might do another video just on FIRPTA because it can get really detailed. But essentially, let's say you buy a house for $800,000. And then let's say you sell that house for $1 million. And let's say you put in, $100,000 in renovations, so your total basis is $900,000. You sell it for $1 million. So your gain is only $100,000. But you have to, FIRPTA withholds 15% on the $1 million. So 15% on the $1 million is $150,000. So now you owe $150,000 tax, or of $150,000, or they'll withhold it. The attorneys usually withhold it, the closing attorneys. So you owe this $150,000 on $1 million in tax. They withheld it. But that's more than the gain that you have on the sale. So it's just awful, because now you owe $50,000. You're now trying to come up with this money that you don't have. And a lot of times, if you don't structure the purchase of the property in the right way, then you will be subject to this, and it's just not a fun situation. Then you have to apply for the government to try and get them and show that, hey, I should get this money back. And it takes usually around a year or longer, and you don't want to be in that situation. So in order to get around FIRPTA, you can get around it with proper structure. So ideally, you would buy the property in a corporation. So as a foreigner, you own the corporation, but you don't own it in your own name. You would set up a foreign corp that owns the US corp. So then this gets around the FIRPTA tax, because it's not subject to a foreign individual 15%. So that is the structure we see most common to get around FIRPTA is make sure that you set up a U.S. corporation with the owner being a foreign corporation, and then you wouldn't be subject to this nasty tax. And we can go more detail in another video of how that all works. If you have more questions about that, then please reach out, message in the comments. Last but not least is estate tax. Estate tax is when you unfortunately die, and unfortunately one day we all will leave this lovely green earth. But when you do, as a foreigner, if you own investments, whether that's stocks or real estate or whatever, investments in the US, you have to pay what's called estate tax. The estate tax is essentially the value of the gain that you leave to your beneficiaries, your heirs. So let's say, unfortunately, like we say in a situation where, we have a Mexican family here, the grandmother had died and she had about like $500,000 in stocks in the US. Side note, a bonus thing you should know as a foreigner, that I know I said 5, but this is 5.1 or something like that. But if you are a foreigner and you invest in stocks, there's no capital gains tax on the sale. So you definitely should be taking advantage of this. So let's say in this case, the Mexican family, the grandma, which did great. She was like, oh, I saw she invested in an ETF, S&P 500 back in the day for, let's say, I think she put in around $50,000. That grew all the way to $500,000. This is years and years and years. Should she sells that, there's no tax because she's a foreigner, so she doesn't pay any capital gains tax. Now she would be subject to any tax, Mexican tax, or wherever she lives if she's not a tax resident Mexican anymore. This is until she was. So it grew to $500,000. She wouldn't have to pay any tax, except maybe in where she lives, but no US tax. So that's amazing. There's no capital gains tax. In the US, that's in long-term capital gains usually 20%, so no tax. But because she owned everything in her own name, she's subject to the estate tax when she died. So basically, when her heirs come to, what happened was her heirs, now her son was wanting to get this money, withdraw it, but because she had died, they have to pay estate tax, and estate tax can be up to 40%. It's a growing scale, it's not all one, but basically it can be up to 40% of the value of the investment. And so in this case, and the exemption in the US is like $11 million. Now that might change here with new tax laws, but if you die and you have estate tax, you're exempt up to $11 million. So up to $11 million in value, you don't have to pay any tax. But for foreigners, that exemption is only $60,000. The exemption is only $60,000 as a foreigner. So that kind of sucks. So $500,000 minus $50,000, so she had a gain of $450,000. She gets exempt $60,000, so she has to pay tax. The heir has to pay tax on $390,000 of gain. So from the $390,000 in this example, based on the estate tax rate, ranging from 18% up to 40%, she had to pay the heir owed around $98,000 of tax on this $390,000, which kind of sucks. So they had to pay it. You file a Form 706 in A to basically report everything. The executor of the estate has to do that, and essentially then you pay the tax and then you get the money. But kind of sucks, they had to do all that. And then depending on the country, if there's some tax treaties where you can get exempt or the rate lowered, but it depends on your situation. And in this case, there was no estate tax treaty, at least with Mexico at the time. So yeah, it was not an ideal situation. I mean, it was still okay, a decent amount of money, but instead of getting $390,000, you get around $290,000 of gain, or yeah. So make sure you're aware of this estate tax. Now, to get around the estate tax, again, there's ways around it if you structure it. When you set up that initial investment account, now it is annoying and it might take a little difference with if you're setting up with like Schwab or Vanguard or Merrill Lynch or whoever, Fidelity, whoever you're investing through. Make sure you set up either a business entity to do the investments through, so that when this happens, you don't have to trigger an estate tax. So you can just change the ownership. So sometimes people will do a trust or an LLC or corporation, but you want to make sure that based on your situation, you do the right entity. If you do it in your own name, you're gonna be subject to the estate tax. So make sure, if you are a foreigner setting up investment accounts, stocks, whatever, investing in the US in the stock market, which I would recommend because you don't pay any capital gains tax. Make sure though you're doing it through an entity so that you don't end up in a situation like one of our clients, and we've seen many times, where you're having to pay this big estate tax for your heirs are whenever you do pass away. So it is something to think about. Now, yeah, I might do a whole nother video on the estate tax because it is, there's more detail and nuance to it, but this is just supposed to be a high level of each situation. But hopefully that helps. So if you are a foreigner, those are 5.1 things you should know about and be aware of, and making sure you're taking advantage of and not either triggering presents or you know about FDAP, you know about FIRPTA, you know about ECI, make sure you're not triggering that in ways you can take advantage of that. But yeah, if you find value in this video, like and subscribe, share it with someone. If you have any questions, let us know in the comments. And if you want to reach out to us and we'll look at your situation, please book a free discovery call and we're happy to help. We do this all the time with people all over the world just like you. So yeah, I hope you got some value out of this video, and we'll see you in the next one.